Welcome to Forex Money USA, where we simplify the world of investing. In this video, we'll break down the basics of stock market investing in the USA. Whether you're a complete beginner or just looking to refresh your knowledge, we've got you covered. We'll cover everything from what the stock market is to how you can start investing today. Let's get started. First things first, what exactly is the stock market? Simply put, the stock market is a platform where investors buy and sell ownership shares in companies, known as stocks. Think of it like a giant marketplace where you can trade pieces of companies. When you buy a stock, you're essentially buying a small piece of ownership in that company. And just like any other marketplace, the prices of stocks fluctuate based on supply and demand. When more people want to buy a stock, its price goes up. And when more people want to sell, the price goes down. Now you might be wondering, why would I want to own a piece of a company? Well, there are a couple of reasons. First, when you own stock in a company, you're entitled to a share of its profits. Companies distribute a portion of their profits to shareholders in the form of dividends. So, as a shareholder, you get paid simply for owning the stock. Second, the value of your stock can increase over time. If a company performs well, its stock price is likely to go up, which means your investment grows in value. That's why investing in the stock market is one of the most powerful ways to build wealth over time. There are several ways you can invest in the stock market. Let's start with the most common investment types. First up, we have individual stocks. This is where you buy shares of a specific company that you believe in. It could be anything from Apple to Tesla to a small startup you think has huge potential. Now, investing in individual stocks can be exciting, but it also comes with higher risks. You really need to do your research and understand the company, its industry, and its future prospects. Next, we have ETFs or exchange-traded funds. Think of ETFs like baskets of stocks that track a specific index, sector, or theme. For example, there are ETFs that track the S&P 500, which is a collection of 500 of the largest U.S. companies. There are also ETFs for specific sectors like technology, healthcare, or real estate. ETFs are a great option for investors who want to diversify their portfolio without having to pick and choose individual stocks. They offer instant diversification and are generally less volatile than individual stocks. And finally, we have mutual funds. Mutual funds are similar to ETFs in that they pool money from multiple investors to invest in a diversified portfolio of assets. However, mutual funds are actively managed by professional fund managers, while ETFs are typically passively managed, meaning they track a specific index. The U.S. stock market operates on various exchanges, with the two biggest being the New York Stock Exchange, or NYSE, and the NASDAQ. The NYSE is the older and more traditional exchange, known for its physical trading floor where traders buy and sell stocks in a bustling auction-like environment. The NASDAQ, on the other hand, is an electronic exchange that's home to many technology companies. Companies list their stocks on these exchanges, and investors like you and me buy and sell them through brokers. But here's the thing, brokers don't just magically connect you to the stock market, they act as intermediaries, executing your trades on your behalf. Think of them like your personal stock market assistants. Now, the prices of stocks fluctuate throughout the trading day based on, you guessed it, supply and demand. When more people want to buy a stock than sell it, the price goes up. And when there are more sellers than buyers, the price goes down. It's all about finding that equilibrium between buyers and sellers. But it's not just about supply and demand. The financial health and performance of companies also play a huge role in their stock prices. When a company announces strong earnings, releases a groundbreaking product, or expands into new markets, investors get excited, and demand for its stock tends to increase, driving the price up. On the other hand, if a company reports disappointing earnings, faces regulatory hurdles, or experiences some other negative event, investors may lose confidence, leading to a sell-off and a decrease in the stock price. Now let's talk about how to actually get started. The first step in investing is opening a brokerage account. A brokerage acts as the middleman between you and the stock market. Think of it like your gateway to buying and selling stocks, ETFs, and mutual funds. There are tons of brokerage firms out there, each with its own set of features, fees, and investment options. Some of the most popular ones include Fidelity, Schwab, and Vanguard. The best brokerage for you will depend on your individual needs and investment goals. When choosing a brokerage, consider factors like trading fees, account minimums, research and educational resources, and customer support. Some brokerages charge a commission for every trade you make, while others offer commission-free trading. Some require a minimum amount of money to open an account, while others don't. It's all about finding the right fit for you. Once you've chosen a brokerage, you'll need to open an account. This typically involves providing some personal information, like your name, address, social security number, and employment status. You may also need to answer some questions about your investment experience and risk tolerance. Opening a brokerage account is usually a quick and easy process that can be done entirely online. With your brokerage account set up, it's time to make your first investment. This is where things get exciting. Now, before you go all in on that hot stock tip you heard from your Uncle Joe, take a deep breath and remember that investing is a marathon, not a sprint. The first thing you need to do is decide what you want to invest in. Are you interested in individual stocks, ETFs, or mutual funds? Remember, each investment type has its own risks and potential rewards. If you're just starting out, I recommend sticking with ETFs or mutual funds for instant diversification. Once you've chosen your investment, you'll need to place a trade through your brokerage account. This involves entering the ticker symbol of the stock, ETF, or mutual fund you want to buy, along with the number of shares you want to purchase. When placing your first trade, it's important to start small and gradually increase your investment over time. After your investment is made, it's important to regularly monitor its performance. The stock market can be volatile, so keep an eye on how your investments are doing. But remember, don't panic over short-term fluctuations. Think long-term. Now, you don't need to become a day trader glued to your screen all day, obsessively checking stock prices every minute. But it's a good idea to review your portfolio at least once a month, or even quarterly, to see how your investments are performing. When monitoring your investments, pay attention to key metrics like your overall portfolio return, the performance of individual holdings, and any dividends you've received. Most brokerage accounts provide tools and charts that make it easy to track your investments. Stick to your long-term plan and avoid making impulsive trades based on short-term market fluctuations. Here are some helpful tips as you start your investing journey. First and foremost, invest for the long term. The stock market is a powerful tool for building wealth, but it's not a get-rich-quick scheme. Don't expect to double your money overnight. Instead, focus on investing consistently over time and riding out the inevitable market ups and downs. Next, diversify your portfolio. Don't put all your eggs in one basket, or in this case, one stock. By spreading your investments across different asset classes, sectors, and geographies, you can reduce your overall risk and increase your chances of earning long-term returns. Third, do your research or invest with a financial advisor. Before investing in any stock, ETF, or mutual fund, take the time to understand what you're investing in. Read company filings, research industry trends, and consider the potential risks and rewards. Another important tip is to control your emotions. The stock market can be a roller coaster ride, with periods of both euphoria and panic. It's important to stay calm and rational, even when the market is going crazy. Don't let your emotions dictate your investment decisions. And finally, remember that investing is a lifelong journey. Stay informed, be patient, and never stop learning. To sum up, stock market investing is a powerful way to build wealth over time. By understanding the basics of stocks, ETFs, and mutual funds, you can start investing with confidence. Remember, investing is not just for the wealthy or financially savvy. It's for everyone who wants to take control of their financial future and grow their wealth over time. Opening a brokerage account is the first step, and from there, making informed investment decisions is key. Remember to diversify your portfolio, invest for the long term, and control your emotions. And as always, do your own research or consult with a qualified financial advisor to determine the best investment strategy for your individual needs and goals. Thanks for watching this beginner's guide to investing in the U.S. stock market. Be sure to subscribe for more helpful tips and strategies on building your wealth. Happy investing! If you're still watching, you're probably as excited about investing as I am. And for good reason. The stock market has been one of the most reliable wealth-building tools for decades. Look, I get it, starting can seem daunting, but remember, every expert was once a beginner. This video is your first step. Investing is a marathon, not a sprint. Start small, do your research, and remember, the best time to plant a tree was 20 years ago, but the second best time is today. So what are you waiting for? Open that brokerage account, start investing, and watch your money grow over time.